Oil is trading at wartime levels, central banks look stuck in a higher for longer stance, and yet U.S. equities are still hovering near record highs. You are watching vTalkInsight, Equity Pulse Daily for May 1st, 2026, where we connect these cross-currents to what is really driving equity markets now. The starting point for equities right now is the size of the energy shock. Disruptions in Middle East production, together with reduced Russian exports, have effectively removed an estimated 5 to 7 million barrels a day from the global market, tightening supply just as geopolitical risk is rising around Iran and the Strait of Hormuz. Brent has surged roughly 17% in just 4 days, briefly trading in the $123 to $126 range and brushing levels where past cycles have seen demand destruction. The risk is not only today's price, but the structure of the market if the Strait of Hormuz remains constrained, because extended disruption would force Gulf producers like Iran and Saudi Arabia to cut output as onshore storage fills up. On top of that, more than 400 million barrels have already been released from strategic reserves, including around 172 million from the United States, with stocks expected to be largely depleted by summer. With U.S. shale producers not rushing to add oil supply and some countries having shut refineries as part of green policy shifts, there is a real possibility that refined products like diesel and jet fuel trade far above crude, with some scenarios pointing toward $200 levels for the most exposed importers. For equities, this behaves like a global tax on consumers and on energy-intensive industries, and it lands hardest in Europe and parts of Asia that rely heavily on imported fuel. We are already seeing that in specific names. Air France-KLM is facing rising fuel bills with no obvious relief. European autos are among the weakest sectors, and banks in Spain and France are under pressure as investors worry about the knock-on effect on borrowers. Not every stock is a loser in this backdrop. Glencore is benefiting from elevated commodity volatility and higher metals prices that offset its own fuel costs, while Norsk Hydro highlights the strategic value of vertically integrated energy and raw material supply, even though its latest results disappointed on free cash flow and leverage. Overall, this energy shock raises the odds of slower growth, weaker margins, and sticky inflation, so the next phase for equities will hinge on whether oil prices push decisively into demand destruction territory and whether there is any diplomatic progress around the Strait of Hormuz. Layered on top of the energy story is a central bank backdrop that is more fragmented and less predictable than at any point in decades. The Federal Reserve is experiencing its highest level of internal dissent in over 30 years, including a rare four-way split over forward guidance, at the same time as incoming chair Kevin Warsh is seen lacking the votes for any quick policy shift. Those disagreements are not about today's policy rate, but about what comes next, because core PCE inflation is expected to remain above 3% and recent quarterly readings have picked up to around 4.3%. With jobless claims back near late 1960s lows around 189,000, the committee has little evidence of labor market weakness, and markets have moved from expecting cuts to assigning a meaningful probability of another hike by March next year. This is not just a U.S. story. The Bank of England has held rates at 3.75%, but built every one of its scenarios around further increases, and markets now price additional tightening from both the Bank of England and the European Central Bank. In the Eurozone, flat French GDP alongside upside surprises in inflation and softer services PMI data underline a stagflation risk that keeps the ECB focused on price stability rather than growth. The result is a global rates complex sitting near multi-year highs, with the U.S. 30-year yield having pushed through 5% and government yield in Germany, the UK and Japan also grinding higher. That is feeding directly into the cost of capital. The spread on debt for software companies has widened by roughly 250 basis points versus calmer periods. Private credit is back to more normal pricing, and large European banks like BNP Paribas and Crédit Agricole are adding to macro provisions even before seeing real stress in client books. At the same time, the bond market is highly reactive to every data point and headline. The U.S. 10-year yield, for example, has already retraced a few basis points after the latest Fed meeting as investors briefly sought safety, and there is a growing view that clearer Fed guidance could eventually calm rate volatility and support a second-half housing recovery. Until that happens, equities are navigating a world where the discount rate is both high and unstable, magnifying the importance of earnings delivery, duration, and balance sheet strength. Against this uneasy macro mix, U.S. equities have been remarkably strong. The S&P 500, Nasdaq Composite, and Nasdaq 100 all closed April at record highs, with the S&P up around 10% for the month and the Russell 2000 gaining roughly 12%. Yesterday, the S&P added about 1% while the VIX slipped below 17, signaling that headline volatility remains contained even as oil and rates flash warning lights. Crucially, this is no longer a rally in just a handful of giants. The equal weight S&P has started to catch up. Earnings growth for the S&P 493, excluding the largest tech names, is running in double digits, and the median stock in the Russell 3000 is finally back to double-digit earnings growth for the first time since 2021. High beta areas, including smaller caps, energy, and pre-revenue biotech names, have outperformed, pointing to a powerful risk on impulse and making an imminent credit accident look less likely in the near term. Flows help explain some of that resilience. U.S. corporates have authorized over $1 trillion of share repurchases this year, the largest on record, which mechanically reduces equity supply. At the same time, retail investors have returned aggressively after tax season, with demand for U.S. equities sitting in roughly the 94th percentile of history and heavily skewed toward mega-cap technology, while hedge funds and other institutional players have kept net exposure relatively low since March. There are, however, signs of froth around the edges. The iShares Semiconductor ETF is up about 40% in April. Intel has doubled over a short period, and the Russell 2000's recent gains are dominated by lower quality, speculative trades that appear driven by retail and algorithmic flows rather than fundamentals. That leaves parts of the small cap and chip complex vulnerable to sharp reversals if earnings or guidance disappoint. Regionally, the split is stark. The United States looks relatively insulated by its domestic hydrocarbon, food, and technology base, whereas Europe remains on the front line of the energy shock. European equity benchmarks are under pressure, with banks in Spain and France weakening, autos and media among the worst-performing sectors, and only energy majors helping indices like the FTSE 100 hold up. Persistent high fuel costs, together with the prospect of further ECB tightening, keep the balance of risk for European equities skewed to the downside, even as U.S. markets enjoy stronger earnings momentum. The other defining force for equities this year is the scale of the AI investment cycle. Amazon, Microsoft, Google, and Meta are collectively expected to spend in the region of $725 to $750 billion on capital expenditure in 2026, well above what investors had penciled in, and AI-centric companies are now directing around 30% of revenue into capex, roughly double historic norms. Alphabet is the clearest example of how equity markets are reacting. Its latest results showed cloud revenue surging more than 60% year-on-year and a backlog of about $467 billion, with over half expected to convert within 2 years, while its core search business accelerated to 19% growth, easing fears that large language models would erode the franchise. The market has rewarded this combination of heavy AI capex and visible returns with a mid-single-digit stock rally to new highs. Meta sits on the other side of that line. Despite delivering roughly 33% sales growth, its shares fell about 9% as higher AI-related spending raised concerns about free cash flow, showing that investors are increasingly intolerant of big checks without a clear near-term payoff. Apple, meanwhile, is being watched closely ahead of its earnings update for signals on how deeply AI will be embedded into the iPhone roadmap. The company faces margin pressure from a tripling in memory prices, but its strategy of pre-securing large memory supplies and its growing services revenue give it a more defensive profile than many hardware peers. Semiconductors remain central to the story. Sector earnings are projected to grow close to 99% year-on-year, and AI-linked chipmakers are trading at market-level valuation multiples despite expectations for roughly 60% earnings growth over the next 12 months. Qualcomm has rallied more than 10% after management flagged accelerating demand in data centers and early signs of a rebound in China's smartphone market, while SanDisk's earnings trajectory is seen as more sustainable than Western Digital's given concerns about new supply from Chinese and Indian memory producers. Outside the megacap and chip complex, dispersion is just as sharp. Atlassian delivered about $1.8 billion of revenue, up 32% year-on-year, raised guidance for both cloud and data center, and is seeing rapid adoption of its Robo-AI platform across more than 75% of the Fortune 500, with AI credit usage growing at around 20% month-on-month. Bosch and Lohm reported 9% revenue growth and a 59% jump in EBITDA, illustrating operating leverage. Yet Roblox plunged over 20% on weaker bookings and user trends, and Reddit slipped despite beating revenue and user expectations, as its valuation left little room for error. Cyclical names are also feeling the strain of the new regime. Ford's chief financial officer has warned that higher commodity costs will hit earnings. Stellantis is under pressure after results raised doubts about the durability of its North American turnaround, and Volkswagen has acknowledged that planned cost cuts are not enough in the face of rising Chinese competition. Among European financials, BNP Paribas managed 9% top and bottom line growth and a return on equity of about 12.8%, and Standard Chartered deliver record profits and strong wealth inflows, but both are adding provisions and facing rising capex needs, which could limit room for ever more generous buybacks and dividends. The overarching message from these stock-level moves is that the market is discriminating hard between companies that can translate AI and capex into visible, near-term cash flows, and those that are simply absorbing higher costs or relying on financial engineering. Putting it all together, equities are caught between a wartime-style oil shock, a higher-for-longer rate backdrop, and an unusually powerful AI-driven earnings cycle. Energy and geopolitics are raising the floor under inflation and threatening growth. Central banks are divided but still leaning hawkish, and yet U.S. indices are at highs with broader earnings participation, while Europe struggles under the weight of fuel costs and banking and auto sector pressure. At the stock level, the market is rewarding clear AI monetization, disciplined capex, and strong balance sheets, and it is punishing speculative small caps, cyclicals facing cost shocks, and business models that rely too heavily on optimistic narratives. From here, the key signals to watch are the path of Brent and any change in Strait of Hormuz risk, upcoming inflation and labor data that could shift rate expectations, and the next wave of earnings from AI leaders, small caps, and European financials. This video is for information only and is not investment advice. If you found this video useful, please like and subscribe to @vTalkInsight. Alternatively, visit vTalkInsight.com to chat with our specialized AI market assistant and access the latest interactive market insights.